Welcome everybody to the webinar. I'm Wade Critides. I'm here with my guy, Barry Brooksby, and we're excited to talk wealth, to talk strategies. We're going to talk growing your money guaranteed and tax-free through the powerful strategy of infinite banking. Whether you're hearing this, on a website, or you heard it through the Getting Magnetic podcast, or you heard it through, Barry, or me, Wade, we're excited to connect together because I think we make a good team, right? Like Barry's the expert in infinite banking. I was like his hardest client asking a million questions. So we figured, why not get together, create a webinar and just answer a lot of questions for people and really showcase how powerful this tool is for building wealth.
Yeah, right on, Wade. And it was so fun getting to know you a few years ago and hearing your questions and your feedback and, playing advocate like, hey, what about this? What about that? And then finally working through to say, whoa, this really is what it is to be. Yeah, appreciate being able to jump on together and, talk infinite banking, talk real estate, talk investing, talk growing wealth, and really enhancing our lives, not only just financially, but mentally, spiritually, emotionally, relationships. True wealth really is all things, not just about money.
Totally. And I see this, that's totally true. True wealth is at the end of your life, right? That happiness, that fulfillment. This is merely a tool that can get you right on the road to financial freedom. And you can start to have your money work for you. And all these things we hear where there's a level of passive income here and all the different things that I've been studying, and I'm grateful we connected. And I'm excited just to educate people on it. Because I think when people know and are aware of this, it almost sounds too good to be true. And we're going to break down why it actually is what we say it is. But excited for people to understand this, because if they apply it, I know it can help change the course of their family's financial future. And I've been a practitioner for a couple of years now, and it's just been amazing.
Yeah. It's funny because there's probably not a week go by where someone doesn't say to me, Barry, I wish I would have learned about this 20 years ago. Why isn't it taught in school? Like your background, I've got a degree in finance. Why didn't I ever hear about this, right?
Yep.
So we're going to go through and talk about why people haven't heard about it, but what they can do about it today. And just a little background, I'm here in St. George, Utah. Wade, you've come to visit me here in St. George. It's been awesome, married with 5 kids. I'm 22 years in financial services, 17-year real estate investor. I've got clients all throughout the country. If you're in New York or Colorado or Minneapolis, I can work with you and help you. My company is Focus Wealth Group, and I am an authorized infinite banking practitioner.
And I want to add there that if you are listening to this and you are from Vermont, we need to talk, because that is the one state that Barry doesn't have a client in yet. So if you're from Vermont, reach out directly and let's get you started here.
That's hilarious. Yeah, I tell people I've got clients in 49 states. Come on, Vermont, right? Well, our goal today, my goal to help all people watching the webinar today is really understand what is infinite banking, how does it work, that it is a better system to help you grow, protect, and use your money tax-free. And I want to help you get predictability, guarantees, grow more wealth along the way, and really know your financial future. Wade, a lot of people out there are crossing their fingers, hoping for a good outcome because they're invested primarily in volatile investments going up and down. They don't really know. So today's webinar is going to teach them how they can know this portion of their future.
Yeah, that was big for me, that I found security. I find security in myself, but instead of having outside factors I'm dependent on and relying on, this kind of brings it back to, okay, I know it's here and there's more security in the financial future, and then I know what I can do with it. So that was a big thing for me.
Yeah, awesome. And here's why. One is we've got a debt problem here in the US. We're going to go to a website. Check this out, usdebtclock.org. This is real time. And there are 2 numbers that I'm going to point out here. We're not going to get into everything on the screen because we'd be here for a day and a half. But the 2 numbers I want to point out is this one in the top left-hand corner. The US recently crossed over $30 trillion in debt. First off, $1 trillion to comprehend is difficult, but 30 trillion, it's almost unfathomable. the country will never get out of debt. This can never be paid. It's near impossible. But here's the bigger problem. See this number down here that says US unfunded liabilities? It's 169 trillion. What that means is the US is on the hook to pay out almost $170 trillion in government programs. Could be Social Security, Medicare, Medicaid, and the 100 other government programs. My point is, it's a major problem. That's one of the reasons why we're talking about tax-free money today, is because how does this get paid for? It's either the government stops spending, which we don't see that happening, they're actually spending more, or they've got to hit us with more tax.
That include pensions, that unfunded liabilities?
From the government pension side or government employees side, that is correct. Okay. Yep. Lots of unfunded liabilities. Also, you just mentioned pension. There's a pension problem and a retirement problem. I call it a gamble because people are taking chances with their future. They're not sure what's going to happen. There's stock market volatility. You hear on the news often, the Dow Jones lost X amount of points and this amount of percentage, et cetera, the S&P 500. And most people are investing in 401ks and IRAs. And the reason I bring this to front is because we're educated in our financial world by Wall Street. And Wall Street would prefer all of us to have as much money as we can in stocks, mutual funds, 401ks, and IRAs. And the reason why, Wade, is because they're earning fees every year. And whether you make money or lose money in your 401k, guess what? They still make money, which is just crazy. You would hope that, I lost money, they're going to lose money, but it doesn't work that way. They're always making money, and therefore they want you to continue to put money in those volatile stock market accounts so they always earn the fees.
Yeah, that's what I realized. I'm very familiar with Wall Street, and once I understood, like, no matter what, Wall Street gets rich no matter what. And we're putting our money into checking accounts and saving accounts and 401ks, and it's just giving Wall Street money to go work and do things, and like they get rich. Wall Street gets rich. And when I looked at the lifestyle I wanted, and I started to look at the people who had achieved that lifestyle, they weren't investing in 401ks for 40 years and then they were abundantly wealthy. I looked at people, I'm like, gosh, you have your 401k for retirement. If you're healthy and you live a long life after you retire, your 401k runs out typically. I'm like, this is not, I can't set myself up that way. I can't set my family up that way. So the traditional go to school, go into debt, get a job, invest in your 401k, buy your house, retire in your 60s and have your 401k fund your retirement, like it isn't really working anymore. And so when I saw that and looked in the future, I was like, I can't go down that traditional path. It's just not it for me.
Yeah. And what's so remarkable is, one, that's what most Americans do. But two, when you look at where Wall Street or these banks and major corporations put their money, they actually own these types of policies that we're going to get in today. We won't take the time now, but I've got other webinars that show this. We can go into the FDIC website. We could look at Chase. We could look at Wells Fargo. We could look at US Bank, and right on their balance sheet, they show billions of dollars of cash value life insurance that they hold. And you got to ask the question, well, why do they have it? So we're going to get into that a little bit in a minute. But as I talk about the stock market, here's what it comes down to. There's no control. I personally, I know you do too, want to be in control of our money. We want to make sure that we're the ones getting wealthy off of our money, not someone else. So there's a lot of stock market volatility. It's up and down. It's very difficult to plan when you have uncertainty. So I want to help people protect themselves against future uncertainty. Well, what's the solution and what are many doing about it? Here's a list of it's a short list of people that use, and so people and corporations and banks that use these high cash value infinite banking policies. And we've heard of these people. Matter of fact, Walt Disney, he helped fund Disneyland with his own high cash value whole life policy. Ray Kroc did the same thing with McDonald's, but you wouldn't think Nike has cash value life insurance. Wells Fargo has cash value life insurance. There's a reason they have it. So I think the social proof is very important. And as you learn more about this, you begin to get on board like, oh, there are more people doing this than I thought. But again, Wall Street and the banks would prefer you didn't know they're doing this. So what is infinite banking? Nelson Nash created this concept in the 1980s. It is a uniquely designed, properly structured whole life cash value insurance policy. This is not traditional whole life. This is whole life on steroids because we enhance the cash value growth, through what's called a PUA rider, paid up additions. We actually minimize the cost of the life insurance to the bare bones minimum, but we're overfunding cash value. And it has to be with a participating dividend paying mutual or fraternal life insurance company. And by the way, I'm an independent advisor. I work with the top companies in the industry. And Wade, like your policy, I mean, these companies have been in business over 165 years. These are some of the strongest, solid financial companies in the US. Infinite banking is a way for people to become their own bank by taking control of the banking function in their lives. And the book that Nelson wrote, Becoming Your Own Banker, he published this in 2008. So I highly recommend reading Becoming Your Own Banker. There's a lot of wonderful financial principles taught in the book. And there is some misinformation out there on the internet. So don't think that if you're reading something about infinite banking, that it's always going to be true. We try to do everything here on the up and up, and we're very transparent about infinite banking, but it's also known as Bank on Yourself, ALIRP, LIRP, which stands for Life Insurance Retirement Plan, cash flow banking, a wealth maximization account, 770 account, private family banking, etc. My point is there's a lot of different names for it. So you've got to make sure that you follow that criteria for a properly structured policy as I outlined in the slide before.
And I give the layman's terms, like high level overview of how I describe it. Now that I know it, Barry and I have read the Becoming Your Own Banker book, so you don't have to, but you will maximize your knowledge and your probably financial future by reading it. But that's also probably why you're watching this webinar. For me, what I tell people is how I understand it, and in Becoming Your Own Banker, and I think the Rockefellers put it on the map for me and probably for a lot of people, but they were like, hold on, let's model after Wall Street. We have enough money. We're giving all our money to Wall Street and they're making money off of it. Why don't we keep all our money kind of in-house and create our own bank, become our own bank? So we put it into this overfunded whole life insurance policy that isn't net. It is a life insurance policy, but it's more so a vehicle. It's a vehicle and it becomes their own bank. So they put it in, they maximize the cash value so they have access to the cash. And they can then use it to go invest in real estate or do other things or pay off high interest debt. And I'm sure we'll get into all of this stuff. And so their money almost stays in-house where they have it. And it's through these big mass mutual companies, Penn Mutual, where they've been earning dividends for over 160 years. There's security there. It grows tax-free. I know we're going to get into all this stuff, but I'm like, hold on. Now my money is going into kind of my own bank. I can access it and draw from it. It's growing tax-free at 5 to 6%. And I can use it to go invest in other things. Not to mention, I now have a family, and I looked at it as a financial vehicle to grow and accelerate my wealth. But the kicker for me was there's a life insurance policy attached to it. Whenever I pass, hopefully it's healthy till 120 and then I drop dead at 120, there's going to be a lot of money going to my family because this life insurance policy is in place. So I kind of looked at it as a way to keep all my money in-house and be able to recycle it and invest it and use it over and over and have it earn on itself.
And you're creating the wealth, not Wall Street.
Mm-hmm.
Absolutely. Well, how do you capitalize on it and establish a plan? I have this question often where someone will ask, well, Barry, how much do I put into it? How much does it cost? Well, the answer is it's really up to you. So my recommendation is take a look at your gross annual income And somewhere between 5 and 25% of that you can put into a plan. Some people are going to feel very aggressive and like, look, I save a lot of money. I'll put 25% of what I'm earning into the policy. And other people are like, be a little more conservative, 5, 10%. 10% is a good number to look at, because I tell clients, let's look at your numbers. My light's going to kick off every 20 minutes. It's crazy. So I tell clients, let's look at your numbers. 10% is good. If you want to go higher, great. I'll make some adjustments. If you want to go lower, we can. The plan we're going to look at today, Wade, is going to be on a 35-year-old female, and she's putting in $25,000 a year. Again, if this is too low for you or it's too high, we can make the adjustments, but this is what we're looking at currently. $25,000 a year into a policy, about $2,000 a month. And what we want to focus on is the cash value growth. If this were in a traditional whole life policy, you would see $0 here in year one, and it would take a really, really long time for the cash value to grow. But you notice in this policy, she's fully capitalized in year 5. She's made whole, okay? We're going to come back to cash value in a minute. What I want you to notice is this $25,000 a year is purchasing $654,000 in death benefit. But what she's paying for is only $327,000 of actual whole life insurance. And that's all she ever pays for out of pocket. But notice there's a growing death benefit over here. And one thing I want to bring up, because clients will say, Barry, I don't care about the death benefit. Well, there's 2 things I really want to bring up. Number one, if you're a real estate investor, you can use this death benefit as a collateral assignment. You can walk into a bank, put your death benefit up for collateral, and borrow more money. So real estate.
That's smart. I might need to do that.
Yeah. But 2, as you mentioned, you have a family. If you pass away early or you live to 120, there's a permanent death benefit. Most people have term insurance. Well, that term insurance is going to expire in 10, 20, 30 years. And once that expires, if there is no life insurance for your family, it's tough to leave a larger legacy, but it also puts a lot of pressure on your other assets to perform. A permanent death benefit really gives you the ability to leave a legacy, to have more capital preservation. It's a great estate planning tool. So there is definitely some living benefit to having a death benefit.
So help walk me through the cash value for people that are like, okay, that's cool. What is that? What does that mean?
Correct. This money is liquid, meaning in any year, a person can take a policy loan. When you take a policy loan, your full cash value is still working for you. We're actually going to draw it out here in a minute. But think of this as your turbocharged bank account, your turbocharged saving account. As you mentioned, it's earning 5 to 6%. Some people, it might be 4 to 6, depending on their age and their health rating. For this 35-year-old, this policy is coming in at a 5% net tax-free return. But the money's liquid. So rather than cash sitting in your savings account earning 0%, you're earning 4 to 6 here, and it's tax-free, which is huge. If you're earning, let's say, a 5% net tax-free return, that's really like doing 7 or 8% in a market-based investment, because you got to deal with the volatility, the taxes, the fees, et cetera. So 5% in a life insurance policy, in my opinion, is remarkable. These are the non-guaranteed values. However, they're more accurate because the non-guaranteed values include the dividend, which you see in this column here. There are guaranteed values as well. This is a fully guaranteed policy. You see the guarantees here in this column. And no matter how old a person is, the guaranteed cash value is always increasing. What I don't like about the guaranteed values is they don't ever include the dividend. But as we've talked about, these companies have paid dividends over 150 years. So it is more accurate to look at the non-guaranteed values. However, the dividend is not guaranteed. We don't know what it's going to be from one year to the next. So you do get guaranteed cash value that's always increasing. And in addition to that, you also get a dividend. Once a dividend is paid, it's locked in. It can never be taken from you. Let's look at a policy loan, Wade. Let's assume that she wants to take a policy loan for $50,000 in year 3. She's going to buy some real estate. She wants this money as a down payment.
Yeah, so that cash value that we saw there is liquid, as Barry said, where you can borrow that from yourself, basically, and use it to go, invest in real estate, do whatever you want with, really. But okay, we're going to go through that illustration.
Yeah, and one thing I want to clarify, the borrowing, the life insurance company actually gives you a loan. So you're not borrowing from yourself per se, but you are using your own cash value as collateral. Mm-hmm. So she's got $67,000 here. If she takes a $50,000 loan, what happens is her full $67,000 is still earning interest and dividends. So she doesn't break any compound growth. There's no lost opportunity cost. She's still earning interest on the full 67, even though she has a policy loan. So if she buys the real estate, she's making money on the real estate and she's still making money inside the policy.
And the compound interest effect, like that was the big thing for me, because I use this policy to maximize the cash value. So I have liquidity so I can go invest it. So what Barry and I know both do, and what everyone, can do what they want with it, but we set up these policies to have the cash value to take out, like this example, to go invest in real estate. I take out 50,000, I invest in real estate. And I know that 50,000, maybe I can go earn 10, 12% on real estate, maybe more, maybe less. It depends on the situation. But it's earning money there. And then that 50,000 is still earning that let's call it 5% dividend within the policy. So you're double dipping to an extent, but the power, if you haven't heard of compound interest, look it up. It is the eighth wonder of the world, right? Where your money keeps earning on itself. And it's that financial freedom of, wow, my money is working for me and earning on itself. So it's now earning here in the real estate portion and in the dividend in the policy. And then obviously we'll talk about being a responsible banker and paying yourself back through the, say the funds in the real estate. But I love that I was earning in both places.
Yeah. And that's the idea. You do want to be an honest banker and pay the loans back. We're going to make an assumption that this line here represents the dollar amount as zero. So you take the $50,000 loan, but you're going to pay it back over what amount of time you choose. And here's what's neat, Wade. The policy loan is flexible. The insurance company doesn't hound you. Oh, you got to make a payment 30 days from now. You could choose to make a payment over a 10-year time frame, a 20-year time frame, a 30-year time frame. I even have real estate clients that are doing rehab on properties, and they don't want to pay a loan back for 10 to 12 months because they need time to rehab the property. They want to get it listed. And then when it sells, they're going to pay the whole loan off. My point is the loan is flexible. There is a 5% interest rate. So we're going to run a calculation, and let's do an amortization schedule in this example for 15 years. So we got 50,000, loan rate at 5%. We take our 15 years times 12, that's 180 months. And we'll pop in our 180 right here. So the payment that you would make back if you chose to follow this outline for the amortization schedule, you would pay the insurance company $395 a month. And in 15 years, your loan would be paid off. Well, what's happening is every month that you make this $395 payment, the balance of the loan is going down. What that means is that you're paying less interest over time. So at the end of 15 years, you would have paid a total of $21,171 in interest. Let's remember that because I'm going to write it down. $21,171. This is interest, and I want to be clear, this went back to the insurance company. They really did give you a loan. You paid the insurance company $21,000 in interest, but that $50,000, it never left your policy. So you were still earning 5% interest on it during that 15-year time frame. The calculator we're going to look at here is a future value calculator, because we want to see the compound effect of the 50,000. And we're only using the 50, not the 67. You're still earning money on the 67, but I want to keep it an apples to apples comparison to show only the 50,000 over the 180 months. There we go. So your 50,000 over the same 180 month time frame earned 105,000. So if we subtract the 50 from the 105, your cash value inside the policy earned 55,000. Now, if you take what you earned and you minus it from the 21, 55 minus 21, even though you had a policy loan, you still came out ahead a positive 34K. There's the power of becoming your own bank.
Yeah. And let alone if you use that 50,000 to say invest in real estate, and that real estate was earning, its own money in a separate, way you're earning money. So you earn 34,000 here within the policy. But for me, what I would do here is that 50,000 is going into an investment property, which let's say I earn 12% on for 15 years. Like that's a whole nother conversation, but you're earning a lot of money in the real estate, let alone appreciation, and you're earning within your policy. And it's just like it's a beautiful thing.
Yeah. We call this the velocity of money, where your dollars are doing more than one thing at the same time. And this helps create more wealth. That's the goal. We're going to take the same 35-year-old Wade, and we're going to make an assumption that she has an old brokerage account, some old stock market investments, old mutual funds. And she's like, man, I really see the power of infinite banking. I want to roll some of that money into my infinite banking policy. So let's say she has $150,000. And for 10 years, we're going to divide that 150 and just take out 15,000 a year and add it to the 25,000 a year premium. So for the first 10 years, there's 40,000 now going into the policy. And then starting year 11, just back down to the 25,000. And you did this in your policy, same with your wife. You guys had some cash. You took that cash, you overfunded it, you put more in year one, and let that now really turbocharge the cash value. It's not required, but if someone is sitting on cash or they're not happy with their 401k performance or mutual fund performance, this is a better place more than likely to put that extra cash to help turbocharge the growth. Now, because that extra 15,000 goes in, Wade, there's more cash value, which means she has the ability to go buy more real estate or invest in crypto or invest in a business, whatever she wants to do. And by the time she runs this out to, let's say, age 65, she would have put in a total of 900,000, 40,000 for 10 years, and then 25,000 through the age of 65. By the way, this is a flexible premium. In any year, she can go down to 6,600 a year. So there's this really wide range from 6,600 all the way up to 40,000 a year, or she could fund any amount in between those two numbers as well. There's a myth out there, oh, don't get a whole life policy because you have to pay the premium your whole life. Not in an infinite banking plan. It's flexible. If she decided, hey, I don't want to put any more money in after the age of 55, she could stop. If she wants to reduce to the 6,600 starting at 56, she can do that. For our example today, what I'm showing is age 65, 25,000. Her total now is 900,000 contribution. That's her premium outlay. Well, look at this. She's sitting on over 2.1 million in tax-free money. What can she do with that?
A lot.
A lot, yeah. And the death benefit has grown to 4.2 million, which is awesome. She paid for 500,000 of whole life, but she got 4.2.
And that gives me a lot of security, because let's say I'm here and I'm 65 and I have 2.1, almost 2.2 million to, let's say, fund retirement, or go buy the property I'm going to live in the rest of my life, or go invest and live. If I invested 2 million, I could probably live off of the dividends or the interest that I earned on those investments. And I also have the security of, even if I use all of this 2.2 million, I have 4.2 million. That was if I were to pass away that year, but I have this legacy I'm leaving my family. So I'm setting them up for success, like, or whether it's your family, a charitable foundation, whatever you want, like, you're building this legacy. This is really like a legacy policy, I see, where it's a financial vehicle, an instrument to build wealth. But then on the other side, you're also building a legacy financially to leave behind for whoever that may be for you.
Yeah. And you mentioned the Rockefellers earlier. What they've done is, yes, use these policies as their own bank throughout their lives. But when a Rockefeller passes away, or family beyond them, there's this large tax-free death benefit that goes back into the family trust, and it has created more wealth. From one generation to the next, those families are always getting more wealthy because death benefits coming into the trust, the family bank. So the idea here is, you want your kids to know about this. You want policies on your grandchildren. Perpetuate the family wealth. This is exactly what the Rockefellers have done, the Kennedys, the Rothschilds, and we can do it ourselves by establishing more policies on family members. And then every generation thereafter is always creating and getting more wealth.
Yes, like we have our 5-month-old daughter at this point of the recording, Cameron, and we're planning on getting her a policy. Like, every one of my children will have a policy. I might even have multiple policies on myself. And really, to set this up is, again, the financial vehicle to use as my own bank to go invest, but also have that, that legacy I'm building with the death benefit.
Yeah, awesome. Wade, let's talk about income, because we see that almost $2.2 million in cash value. Let's talk about the income play and her being able to now take a tax-free stream of supplemental retirement income. What does that look like? So the next illustration, starting at age 66, okay, this is the exact same number. Here's the 900,000. Here's the 2.19 million we just talked about. But now I'm showing that her income is going to be 140,000 a year. Now,
meaning taking that out means she's paying herself that, right? From her policy, from her 2.1.
That's correct. And she's stopped contributions. So she's not putting in the 25. She's not putting in the 40. She's not even putting in the minimum 6,600. Now she could, okay, there's 3 things I want to emphasize here. She could continue the 25 grand at age 66 if she wanted to. The second option is she could reduce to the 6,600 minimum, or the third option is she could stop.
Mm-hmm.
I'm showing the third option, no more money going in, which is why we see the zeros here. Now she's going to be taking money out. And it's 140,000 a year from the 2.2 million. And it doesn't have to be 140,000 equal every year. She could do 150 one year and 50 the next. I'm using a consistent 140 here to make a point. This runs from the age of 66 to 90. Now remember, Wade, how much did she put in? Total contribution, 900,000. There's her total. She's able to pull out 140,000 through the age of 90. How much money is that? 25 years, 140,000. It's $3.5 million. How is she able to do that? Because she only had 2.2 to start with. It's because when she takes out the 140, the remaining balance of the cash value, it's still earning interest and dividends. Remember, we talked about that compound growth curve. Money's still working for her in cash value, even though she's taking a loan. So here's the net effect. She pulls out, or she's put in 900,000. She pulls out 3.5 million tax-free. And if she passes away at age 90, Wade, there's still a $717,000 tax-free death benefit that goes to her beneficiaries. Boom. Unbelievable. It's just so remarkable to see.
It is. And you think about that, like, say, let's just use round numbers, 2 million at the age 65, earning a 5% dividend is $100,000. So you're earning $100,000. Your money is just making $100,000 a year without you lifting a finger. So you could theoretically take 100,000 out, right? And it would just stay, that 2 million balance would stay the same. So 100,000 over 25 years is, you're taking 2.5 million out and your 2 million remained the same.
Yes.
So you could theoretically live off the interest and just live off $100,000 a year, and your balance would stay the same, and you would have 2 million still, and it wouldn't even decrease. This is taking 140 out. Yeah. For 25 years. It's amazing.
So not only is she pulling out more than the 2.2 because she's getting 3.5, but what does 140,000 tax-free look like if it were taxable? She'd have to be pulling 200,000 plus probably out of a 401k or IRA to net the 140, right? Depends on tax brackets, etc. Mm-hmm. But one of the points of this webinar is tax-free income, because of all
we don't know where taxes will be when this woman is 90 either. Like, who knows what the tax brackets will be? There's no security in that.
Yeah, and maybe the government will be $200 trillion in debt at that point. If who knows, right? It's crazy. Right. But when you look at the power of her ability to grow money guaranteed, have access to that liquid cash along the way, and pull out tax-free income, in my opinion, and I've done this for 22 years, this is the most powerful financial product, the most powerful financial tool out there in the entire industry. Mm-hmm.
So actually, I do have a question, devil's advocate here. So why does the death benefit value go down? Like, it's at 717 when she's 90.
Yeah, glad you asked. Any outstanding loans and any interest accrued come off of the death benefit when you pass away. So the insurance company is using your death benefit as collateral. They're going to give you the difference. However, if she passed away at age 65, they would pay out a $4.2 million death benefit, right? So if you add the 3.5 million plus the 700 that her family still gets, it's the same 4.2 number. So this holds true at any point. If she passes away prematurely, I actually had a client pass away at the age of 41, married with 3 kids. It was a tragedy, but fortunately he had this type of policy plus some term insurance. Well, if she passes away at 40, and has no loans, her family gets 1.7 million. But let's say she has a $100,000 loan. She passes away at 41, the insurance company will reduce the 1.7 million by the $100,000 loan outstanding. The family would still get 1.6 million.
So doesn't the loan, like in this one at 90, isn't the loan coming out of the total net cash value, or is it coming out of the death benefit, or both?
It's both. That is correct. So it does come out of the cash value because we're doing 2 things. We're taking a withdrawal up to the 900,000 that she put in. The loans don't start until the 900,000 has been exhausted, but there are loans. But here's the difference. Remember, earlier in her life, she's going to pay the loans back. She's going to be an honest banker through her 30s, 40s, 50s, etc. But in retirement, Wade, she doesn't pay the loans back. So they have to be paid somehow. And that's what the death benefit is there for family, but also to pay off those existing loans and any income that she's pulled out. Again, her 900,000 that she put in has a total of 3.5 million to her in income and 700,000 to her family. So she basically more than 4 times her 900,000.
Got it.
To reemphasize, properly structured infinite banking, guaranteed, liquid, it's protected, it's tax-free. Ways to use infinite banking: Obviously, loans for business, real estate, other types of investments, etc. Pension maximization. There are people that still get pensions. They're fairly rare these days, but it's possible to use an IBC policy to actually get more money from someone's pension. Collateral assignment, we talked about that, taking your death benefit to a bank and being able to borrow more money. You can pay off higher interest rate debts. You might have lines of credits that are higher than 5%, student loans, credit card debt. So if you have loans with high interest rates, take policy loans at 5% and go pay those off. That makes a lot of sense.
Mm-hmm.
Businesses can use it for equipment financing, tax-free retirement income, on and on and on and on. The possibilities really are infinite, which is why we call it infinite banking. And we'll kind of wrap up where we started, and that is the social proof. You just got to ask yourself, why do banks and corporations and Wall Street have these high cash value policies? And you would think if they have them, you would probably want them too. So I would invite everyone, learn more. We obviously appreciate everyone for attending the webinar, but I'd invite you to look at your own numbers. Here's the website for my company. You can email me, call the office. When you look at your own numbers, Wade, you experience this. It's like, oh, the light bulb turns on, you see what's possible for you, and you're able now to see the math behind it. How is your cash value going to grow? You might want to do 25,000 a year. You might want to do 200,000 a year. You might want to do 10,000 a year. That number that you decide to put into a policy is up to you, but I would invite you to look at your own numbers.
Question for you. What is, you would say, the minimum, like if they were working with you, to put into a policy to get a policy started?
Someone in their 30s is about $400 to $500 a month.
Mm-hmm.
40s,
6,000 for the year.
Yeah.
For the initial.
And if they're a little older, then we need to bump it up to $700 to $800 a month. Yeah.
Yeah. Okay. Yeah. I mean, for me, I look at this as, especially for people that are like, okay, I'm unsure what to do with my money. Most people put it into Wall Street and 401ks. I've done a lot of my own independent research and studying of this. Barry is a professional in this industry. It's my personal opinion, this is one of, if not the best place you can put it, for two reasons. It's one, you're putting your money to work. It's safe, it's there, and it's never leaving, right? You can take policy loans for yourself, but it never leaves. Like for me, I had a 401k from my finance career during actually the global pandemic. I was able to take that out without penalty. And I said, I'm taking it out of Wall Street and I'm putting it into this. And once it's in there, let's just use round numbers. Let's say it was 100K. Once that 100K is in there, it doesn't leave. I can take a policy loan against it to go invest in real estate or do whatever I want, pay off high interest debt, pay off student loans. But that 100,000 is in there and it's earning and it's growing and it's accruing dividends. And there's a death benefit attached to it. So one, it's somewhere to put your money where you know it's going to work for you. Two, you can accelerate your money and make it work for yourself even more by using that banking, and it's earning within the policy, but going to invest in real estate, which is what I do, or crypto or whatever, or stock market, whatever you want to do. And then three, it's building that legacy of whenever I pass, there is going to be this policy that, my heirs or a charitable foundation is going to inherit. So you're kind of leaving that legacy behind too, but it's easy to get started. How does someone get started? Is there like a lot of hurdles? Is there a lot of stuff to go through, or what? If someone's like, I want to do this, where do they begin?
Yeah. First thing, we get on a call and begin looking at their own numbers. I want to learn about them, their financial kind of overview. Their goals are very important. And then we put the numbers together. Once we go over the numbers, then it's very simple. They do an application call with my assistant, takes 15, 20 minutes. And then they go through the underwriting process, which is basically, we just wait to hear from the insurance company on what they get approved for. Once we have the approval, we're talking again, going over the final numbers, and then they implement the policy and begin growing that guaranteed compound interest.
Awesome. Yeah. For me, this was a no-brainer. And, if whoever's listening, watching this, like, you can reach out to me, you can reach out to Barry if you have questions. And I'm just excited for people to educate and spread this, because I think it's unknown, and it's like especially your responsibility. But now that I know about it, our responsibility to educate people and let them make their own decision. But I've done the research, and this is a really sharp move as far as building wealth goes and leaving a legacy.
Yeah, totally agree. And we don't want people in the future to go, man, I wish I would have learned about this 20 years ago. Now's the opportunity. You've learned about it. Look at your own numbers. Wade, thanks for having me. It's great.
Yeah, thank you.
Be together and talk about creating wealth and legacy and growing money tax-free. Thanks, Wade.
Yeah, thank you. Grateful for you, Barry.